Hello and welcome to the 20th lecture of the course Forex in 3 Steps. In this lecture, we will discuss something very important in trading, which is currency correlation and financial market correlation. What does that mean and why is it important? Knowing which markets are related to each other and move together, and knowing the markets that are moving opposite of each other is something very critical and very important in trading. This is because if you decide to specialize in several markets, determining these patterns can help you make much more wiser investment decisions and trading decisions and may help you profit much easier. So let's take a quick example. I'm analyzing gold and Euro USD, for example, and then I see that they are correlated in some certain way, and I realize that they have been, for the past few weeks, they've been moving together. When gold goes up, Euro USD goes up. When gold goes down, Euro USD goes down. So if I'm analyzing both of these financial markets and I realize that there is a very good setup or very good investment opportunity or trade opportunity on gold to buy, and then I move on to Euro USD and I don't see the same setup, I don't see the same trade opportunity, then maybe this is a signal that this might not be the best idea. And on the other hand, if I go to gold and I find a nice trade opportunity and then go to Euro USD and find the same good opportunity, that's what I call confluence, and this is something that guarantees the trade even more. And that is why you need to be aware of how the markets and how financial markets are correlated together. And this is something you gain experience at by time and by effort, but as soon as it clicks, it will help you with your trading massively. Let's start with the first type of relation, which is zero or weak correlation. What does that mean? That means there is no link or relationship between two financial assets or markets. For example, crude oil and the Tesla stock market. These two financial markets have no relation to one another, and whatever happens on crude oil does not determine anything about Tesla. They do not move oppositely and they do not move similarly. The second type of relation is a negative correlation. What does that mean? It means that two assets move in opposite directions. For example, the USD against gold. When the USD goes up, it means that gold goes down, and vice versa. So if you're ever analyzing gold and you find a nice buying opportunity and then you go on USD and find a similar buy opportunity, that means that something's wrong. And that is why it is important to know which pairs or which financial markets are negatively correlated, to be able to identify and find possible traps with your trading. But for example, if I'm analyzing gold and I find a nice buy opportunity and then I open the USD chart and I find a nice sell opportunity, that means that there's confluence and they are both telling me the same thing. When gold goes up, USD goes down. So if this is pointing down and this is pointing up, then I may have a very nice solid trade opportunity. The last type is a positively correlated, which means that two assets move in the same direction. There are many examples. One of them is Euro USD and GBP USD. Since both currencies are European, the Euro and the GBP, they move very similarly, and especially since both of them are also against the USD, both of these pairs move very alike. Also, the stock market indices like the Nasdaq and the S&P 500 move very similarly as well. The Dow Jones also moves very similarly to both the Nasdaq and the S&P 500. You will be able to identify them as long as you're trading, as long as you're analyzing charts. You will find it's very easy to identify which assets or which financial markets are moving together and which are not. And you can use the same scenarios here. For example, if I'm analyzing Nasdaq and then I go on the S&P 500 and I find a very similar setup to the Nasdaq, that means there's confluence. Both markets are telling me the same thing, which means that the trade or the likely direction they're both telling me is likely to happen. Let's talk about some other currency pair relationships in financial markets. One of them is Euro JPY, GBP JPY, and USD JPY. All these three financial markets move very similarly, and it's wise to write this down so you can be able to identify which markets are moving alike. Other markets that move alike are the euro against the Swiss and the USD against the Swiss franc. And also finally the NZD against the USD and the AUD, which is the Australian dollar, against the US dollar. The importance of understanding financial market correlations and inverse relationships. So again, it helps avoid repeated risks when trading correlated assets. And this is very important. So for example, if I'm trading Nasdaq and I see a very nice buy opportunity, I click enter, I click buy, and I go into a buy trade on Nasdaq. Then I keep scrolling and I find S&P 500. I also find another very nice setup that I want to take. So I also buy and risk another chunk of my capital on the S&P 500 trade. That means that I'm now risking in a positively related market twice the risk I'm supposed to risk, because I'm basically entering with two trades in a very similar market or a very similar market. That means if I lose, I will lose both trades, which will hurt your capital and it will make you lose double what you're supposed to lose. So this is very important. The second thing is it enhances effective portfolio diversification. And diversification, like we said at the beginning of the course, is very important when investing. Your portfolio should be diversified, and therefore knowing which markets are correlated and related helps you diversify even better. Thirdly, inverse markets can be used for hedging purposes. What does hedging mean? Hedging means opening two trades at the same time in opposite directions, meaning buying and selling on the same asset. So whatever happens, you're winning. But it needs to be done in a way to be profitable, because if you buy here and sell here on the same market, then you will be break even. You will whatever makes you profit, the other trade will make you lose it. But it needs to be done in a specific way. We will cover it later on in the course. But understanding correlations of the markets and financial markets can help you hedge. It can also help you confirm the trend when multiple assets move in alignment, like we just stated. And also lastly, it's useful for reading overall market sentiment. And that is it for this lecture. See you in the next one.